Good morning. Huh. Sorry for the delay this morning. Let's see, we have, so cool. So everyone's already in here. So I did post in RHINO Wealth and said I was going to be a half hour late. My wife and I took our son to the doctor this morning. Hey, Frida. And it went a little longer than usual, which is not a bad thing. It was actually a good thing. They were just backed up and, you know, life happens. So my apologies, but actually one of our rhinos who's already here called me and she goes, "Aunt, are you okay? You're never 8 minutes late." And I thought that was so sweet. So thank you. And anyone that knows me knows I'm never more than 1 minute late. And even that happened like one hand's worth of times, right? So I do appreciate looking out for me. Yeah, just a checkup. Went really well. In fact, everything about him is above, is in the top 1 percentile. So that's good. And I think the doctor said it's almost like he's not even human. It's like he's a rhino. And I said, yep, he is. Okay, so let's jump into things. So full disclosure, I do know where the market is. I did look at it, I believe. When I did take a look, it was down 160. And the NASDAQ was down almost 2%. So that's where we're going to start. Now let's talk about last week and then we'll catch up to where we are. Sorry, in bringing our son to the doctor, my wife wanted to get a dozen bagels for the staff to be nice, right? Because they did take us early. And in going to get some, hey, Deborah, in getting bagels for the staff, I was like, you know what? I'll grab some breakfast too. So we got 2 wake-up wraps from Dunkin' Donuts. But then I wanted hash browns. And then I wanted a chocolate croissant. And then I wanted a giant cold foam coffee. So there's a little bit more of me today than usual. So my apologies. Anyway, enough about me. So last Monday, we had a bit of a kumbaya moment, a bit of a, you know, what we did wrong with Eli Lilly. And what we understood and what we recognized was not correct. Okay. One of the things I do want to share that I can share now is obviously we identified what went wrong with Eli Lilly. We took that strategy and moved forward in terms of applying it to the next one, which was WELL. In fact, what we identified about WELL was, okay, everything looks great. But then we sold it only up 1% because we were not going to make the same mistake as Eli Lilly. We recognized that the reasons we bought it were not coming to fruition, that it was being overly stubborn. And then we took a little bit deeper look into it and recognized that it was a real estate investment trust, which we knew, but in giving a bit of an autopsy, a premature one, hey, why is this not moving? And it was in the NASDAQ, and the NASDAQ's going down, but this isn't going down. What we recognized was when rates go up, real estate investment trusts go up as well because they are managerial services, right? They lease out their properties to other people. Their properties are finite, but if rates go up, the rents that they bring in goes higher because interest rates are going up. Therefore, when interest rates go up, real estate investment trusts go up. So that kind of stinks. And we're like, all right, well, let's not make the same mistake. Let's just get out of this. So we went ahead and did a deeper look into all of the stocks and we saw a JKHY. It was 20, it newly crossed over, it broke a trend line. Looked beautiful. So we purchased it. In fact, we bought a little more and a little more and a little more. And now we have a full position of it. Doing a deeper look what JKHY is, it's a tech company that operates within the financial services industry. So we see that financial services have been getting hit. We see that tech's getting hit. And this is the only company that has not got hit. For the life of me, I cannot find another company in the NASDAQ that has not got hit. That's a tech company. For the life of me, I cannot find another financial services company that had not got hit in the entire market. This happens to be both of them. So naturally, the first thing you should do is, well, emotionally, you're like, yay, I got it. This one is the one. But then you have to sober up and ask yourself and do a little work. Why is this not going down? And what you might find is like, well, WELL, it might have something that you don't know about. Oh, interest rates go up and this goes up. All right. So we did a deeper look and we don't see anything that would scare us off. In fact, we went through the whole balance sheet. I personally tore the balance sheet apart. And what I recognized was from last year to this year in terms of earnings, their earnings were better, but it's because they went ahead and leveraged the company up. They took on like 220 million worth of debt that they're paying an interest rates on, and interest rates are going up, so that's becoming more expensive, to then go ahead and buy the stock. So they bought their own stock, which meant there's less shares on the market, which meant the earnings per share go up, right? So let's take, I don't want to say that too quickly and not go over someone's head, right? So let's just take a second. Companies, when you hear the government saying, oh, these companies are just out for the rich, right? They're using the money to buy back shares and it always benefits the rich. You may not actually know what that means because for years I didn't know what that meant. It just was a sentence, it was a soundbite that didn't actually make sense to me. I just knew it to be true. But unless you actually allow it to make sense to you, you don't get the full juiciness of it, right? So a company, what it will do is the money that comes in, all the employees of a company are bonus for the most part based on stock price, especially the CEO. The higher the stock price goes, the higher his compensation is because the more he's worth. If a stock price goes up, conceivably the company's doing well and it's agreed upon by the entire market. So it's a very, very good barometer of how the CEO is doing. It's completely independent of personal opinion. Oh, the CEO is a good guy. He buys me coffee every morning. I like him. None of that matters. Is the stock going up or is the stock going down? That's all that matters. 1 second. So all right, hold on. So my camera shut off because my phone has very low battery, but I'm on it, right? So let's do this. How? So people remember back in the day, Anthony would yell and curse when things like that happened. Anthony's in a very kumbaya moment these days. I'm totally good. Anyway, so a stock will go up, signifies that the CEO is doing well, right? Now, why does a stock go up? More buyers and sellers, right? Okay. So in that, as you do the Socratic method, right? Like why? It matters how many buyers there are, and it matters how many sellers there are. But what's the other side of that equation? How many shares are there? Because if you have 1 million buyers and there's 2 million shares, it's not going anywhere. If you have 1 million buyers and 500,000 shares, it's going to go up because those 1 million buyers overwhelm the supply. Demand overwhelms the supply. So what a company will do is the money that comes in, they'll use it to buy their own stock. In buying their own stock, they lower their share count, which means there's less supply, which means the same amount of buyers has an increased impact on the stock price. Therefore, when a company is buying back their own shares, they're artificially and mechanically manipulating, not manipulating, but engineering the stock to go up because they're decreasing the supply while conceivably the demand is the same, right? Yeah, we're doing good. The demand is the demand. The supply goes down, hence the stock goes up. Now, what JKHY has done is they sold debt. They borrowed money to buy back the stock. That's like red flag. That's red flag territory because they're not even buying the stock with the money that they have. They're borrowing money to buy back the stock. So not only do they have less of a share count, hence earnings per share, the earnings they have per share, and the shares have gone down, the supply has gone down, so the earnings per share have gone up. But now the debt levels have increased and the interest on the debt is increasing. So they've pretty much mortgaged their future to go ahead and show the stock is going up, which we all know can't last forever, which means something is horribly wrong with this company. There's something that we don't know about, and there's something that they're trying to hide, in my independent personal opinion. So that being said, I'm very happy with this position. I think fundamentally the stock is going to get annihilated. But I also have identified that technically the stock looks like it's going to get annihilated during a time period where interest rates are going up, which means tech goes down. So let's unpackage that. Why is that the case? Well, most tech is unprofitable, right? To go ahead and build a tech company, you have an idea, then you have a business plan, then it's R&D, 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 then maybe you get profitable and then you scale it. That's the way tech works. In doing R&D, 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 where does that money come from if you're losing money? You're borrowing it, right? So even a company like Google didn't become Google until they borrowed money. Hey, we have this idea. Please lend us money so we could build the idea, right? So in doing so, that is the model for any tech company. Uber, Amazon, just actually, as silly as it sounds, became profitable a couple of years ago. Let's see, who's unprofitable that you really know a lot of? What was it? Robinhood, right? Robinhood, we all know Robinhood. They're not expected to be profitable until 2024, right? So a lot of tech is unprofitable. The point is build it and then figure out the profit, but get the tech down first, secure the tech, build the product. So the way tech works is when interest rates are going up, all that money that you have to borrow for R&D becomes more expensive, which means the time frame that you're going to eventually be profitable gets pushed out because you have to then pay back a higher amount of money to go ahead and borrow the money you need. So if I borrow money that only costs me 1% a year, all right, at 1% cost of money per year for the next 10 years, I can be profitable by year 11. Now, all of a sudden, if the cost of money is 3%, well, my cost of money is 3% per year. It'll take me 17 years to become profitable. Now, if it all of a sudden takes you 40, 50% longer to become profitable, your company is worth less because it has a longer time period to become profitable. So when interest rates are going up, tech as a whole, tech as an industry comes down. Now, if you see interest rates are going to continue to go up, you have a real problem with tech. Now, the thing with tech is it has not cracked yet. So we see it going down, we see it down 20%, and a lot of people chase the hoorah stocks, right? Like the go, go, go stocks. And they're like, Ant, I don't know what you're talking about. My company's down 40%, 50%, 60%. Yeah, well, you know who's not down 60%? The largest company in the world, Apple. You know who's not down 60%? The second largest company in the world, Amazon. You know who's not down 50%, 60%? The third largest company in the world, Google, right? Like in the world. You know who's still not down? That Microsoft, one of the top 4 largest companies in the world. I just named you the 4 largest companies in the world. You know who was the 5th largest company? Facebook. You know who's not even a top 10 company? Facebook. Because they did get annihilated. Now you have earnings season coming up, which means presumably one of those top 4 will be the next one. Which one of those stocks is going to disappoint and get slaughtered? I don't know. I would tend to believe maybe Google, because it's kind of the same thing as Facebook, but not, but is, right? One of those things. And when that gets slaughtered, what happens to the tech market? Because the tech market is hanging on a trend line. It's going to crack. And if it cracks, what happens? It cascades down. Because you got to remember the nature of the market. It's buyers and sellers. Well, the people that own companies are all on margin, right? Like the large funds, they borrow money to increase returns on their portfolio. Hey, I have $100 in stock. Would you let me borrow $100 against these $100 so I could buy $100 more? Meaning if my portfolio goes up 1%, I'm really up 2% because I have twice as much stock, right? Cool. But what happens when those stocks start going down? They then have to sell twice as much stock as they own just to go ahead and bring in cash, to go ahead and give the bank, to go ahead and pay back some of the leverage, the margin, the borrowing that they use, because they have to keep a borrowing rate, right? So if the bank says, you can never borrow more than 50%, okay, I have $100, I borrowed $100 free. I'm at 50%. Well, what happens if a stock goes down 1%? Well, it's down for you 2% because you own 1% and you borrowed enough. You borrowed exactly half, exactly the full amount. So your 1% down is actually 2% down for your portfolio because you're down 1% on your cash and you're down 1% on your borrowing. If you're down 2%, what is the ratio in your portfolio? Well, now you actually only own 48% of it because you're down 2%, which means you went under that 50% threshold. So how do you get back over the 50% threshold? You bring in money and send it to the bank, and they say, hey, you're down 2%. You better give us 2%, or we're going to sell your stock and take the 2% ourselves, which they're legally able to do. And they do quite often. It's called a margin call. Okay, well, we'll send you the money. All right, write a check, send it to them. Happens again. All right, write a check, send it to them. Happens again, write a check, send it to them. Where's the point where it doesn't just happen? It happens, right? Like everyone just says, you know what? F this. I want nothing to do with this. Just sell my stock. I don't care. That's when it cascades. So right now, there's a lot of money that are in the safe companies. Apple, Microsoft, Amazon, Google, maybe Tesla. But what happens when one of those companies falls apart? Well, then it cascades and pulls the portfolio down. We saw that happen with Facebook, and tech has gotten annihilated ever since. Well, what happens if that happens with Google or Microsoft, or God forbid, Apple, the most sainted stock in the entire world? Well, at what point do those portfolio managers say, you know what, just sell it? I don't care. I've been wrong. Get me out of this. The point is that's still in front of us. That still has not happened yet. Meaning we're on the precipice of that happening. Now, what we've always talked about bonds, right? Like I've always talked about bonds because I've always said they're the ground zero. They are where the next financial catastrophe is going to happen. And that's kind of where Armageddon happens. Because there is no one that could bail out a bond market. You could bail out a stock market, you could bail out a mortgage market, you could bail out a financial market, because what do you do as a government? You sell bonds, bring in money, and use that to wallpaper. You could even bail out COVID. Oh my God, we need $5 trillion. All right, let's sell $5 trillion worth of bonds, take the $5 trillion and put it here. But what happens when the bond market blows up? You cannot sell bonds to fix bonds. Like that does not happen. I'm looking at messages coming through, sorry. So when that happens, you have a real problem. Like there's no saving, it just falls where it falls. Now, what would allow that to happen? And we've always spoken about this. The government owes $30 trillion in bonds, right? We have 30 trillion outstanding. The money we owe on that is called an interest rate. That's a 1 month, 2 month, 3 month, 5 months, 6 month, 12 month, 1 year, 2 year, 3 year, 5 year, 10 year, 20 year, 30 year. Those are the durations. So every one of those intervals, we're sending part of that money to those bondholders, which are mostly sovereign wealth funds like other countries who don't like us so much right now, China, Russia, Saudi Arabia. But it's also held by retirement institutions like your Vanguards, your 401ks, your government pension funds, which all, by the letter of the law, have to own at least 70 to 80% worth of bonds because they're deemed safe. But they're actually the riskiest asset out there, because if you asked yourself, okay, the government owes $30 trillion. How are they ever going to pay $30 trillion? Oh, wait, inflation is 8%. We're going to see what the inflation rate is tomorrow, but it's going to be around 9%, which means the $30 trillion owed is actually losing 8 to 9% worth of purchasing power per year. Okay. So what interest rate would you have to compensate someone that you said, I'm going to borrow money from you for 30 years, and the value of the money I'm going to pay you back in is going to lose 8 to 9% per year? Well, I don't know the math behind that, but it's probably like an interest rate of like 100%, right? It's 30 years at 8% is what? So 30 times 8 is 8240. I mean, it comes out to a very large number, like 240%, which obviously that's like the highest interest rate ever in the history of the world. So that would be a fair interest rate. We're at 2%. Now we're at 2.7%. The point is, in paying someone back, like we talked about tech, in paying someone back, it's how much money do you have? How long will it take you to pay them back? So we can't pay 30 trillion at 0%, like the country is broke. How long do you see before we come into 30 trillion? Well, the tax receipts of this country is 2.5 trillion, 3.5 trillion per year. So if we did not owe pension funds, Medicare, all governments, if we didn't owe any of that, it would take us about 10 years to pay off our debt. Meaning there wasn't a single dollar for government or social spending at all. And we know that's not the case. In fact, we operate in a deficit every year. We're a 1 to 2 trillion deficit per year. So not only do we not have enough money as a country, but we're losing money every year and we owe more every year. So that sounds crazy to begin with. Okay. Well, we could keep this charade going. Well, we come into 3.5 trillion, we sell 1 trillion or 2 of bonds. Our interest payments per year are like 800, 200 billion, 250 billion. All right, we'll sell 1 trillion, give the 250 there, the other 750 billion we spread around. Cool, we could operate. If you don't know, it's called a Ponzi scheme, right? Like Bernie Madoff, the US government is doing exactly what Bernie Madoff did, except one of them has a military and can jail the other one, right? So as that interest rate goes higher, the money that we owe in interest payments every year goes higher. At what point, this is the question to the entire market. What interest rate does the bond market then say you have zero ability to pay any money back? And not only do you have zero ability, but we know it and everyone knows it. And we have to sell this SHIT before the next person sells it, because when everyone sells it, this will be worth zero. So we need to sell it now before the next person sells it. Because when everyone believes that, they all rush to sell it, which means interest rates continue to go higher. And you're seeing it right now. Interest rates are going higher. As interest rates go higher, retail spending goes down, mortgage applications down, tech goes down, countries' ability to borrow money goes down, which means social programs go down. Do you believe that's in this stock market yet? Because it's not. Now, all of that being said, in the last X amount of weeks, the stock market has inflow of money. It's been a net, someone is a net buyer of stocks. And this is the dynamic we've always shared with you. Foreign money has no place to go but the dollar. The second largest economy in the world is China. Do you want to send $1 trillion to China? Do I need to wait for an answer? Because I don't think I do. One of the top 5 largest economies in the world is Russia. Do you want to send $1 trillion to Russia? Okay, Europe. Let's send it to the second largest financial center in the world, London. Do you want to send $1 trillion to Europe? I don't think so. It's the biggest socialist governments in the world. Their social programs in Europe are absolute. Okay. Well, and then think about Europe. You have Russia in war with Ukraine. You have Poland over here. You have Sweden and what's the other country? Another one entering NATO this summer. See, the problem with Europe is it's continental, right? Like, yeah, you could be a country, but you're bordered with other countries that all compete with each other. So a war in Europe sucks everyone in. So you can't send it to Europe, because if Britain or England or whatever gets into a war, do you think all of a sudden they say, well, we can't fund this war, our country's going to go and get killed because that $1 trillion the US sent us, we can't touch it, it's theirs. They say, no, like, we'll deal with you when we're still alive to deal with you, but the money in our country, we're using it to fund our war. Right? Now, you send it to the US because do you ever imagine a time where tanks are just going to show up on the shores of Virginia? Like, is Russia going to be able to send tanks to New Jersey? You can't. We're such a large landmass that's perfect. We have an ocean over here. We have an ocean over there. We have the Canadians over here. We have the Mexicans over here, right? None of them are sending tanks to us. And if you send a missile to us, That's what NATO is, the UN. We have countries that are part of the United Nations and NATO that we put missile defense systems in. So if anyone from Europe sends a missile this way, if Poland doesn't get it, Sweden doesn't get it, France will get it, Spain will get it, Portugal will get it. There's so many. And then if they all miss it with their missile defense systems, it has to go over an entire ocean where we have ships and ships. And nobody can touch the US. The only way to touch the US is economically, which is our bond market. So don't kid yourself. There is a war going on, but it doesn't mean ships are coming to our land. It doesn't mean tanks are coming to our land. People are selling the bonds knowing that it's going to cripple the country. But in terms of a place that can't be militarily attacked, in terms of a place that has a rule of law, in terms of a place that guarantees money, in terms of a place that is the currency reserve of the entire globe, in terms of a place that's the largest economy that can absorb money, in terms of a place that has the largest corporations in the entire world, that's the US. So you don't have to be someone tall. You just have to be the tallest midget, right? The tallest midget is king. In the land of the blind, the one-eyed man is king. That's the US. So you have money flow coming to us, even though we're far from perfect. So the question then becomes, what's the dynamic? How far down do we go before the money flow catches up? I submit to you that that is lower than where we are today. I submit to you that when that hits, we will take off like you've never seen before. I submit to you by 2030, the stock market's going to be over 60,000, because when you add the variables of money flow plus currency risk plus inflation plus companies and balance sheets, you get to a world where the US is just the best place you could ever dream about putting your money. So as of the last week, hedge funds have been net sellers of the stock market, while the stock market has seen net inflows into it. Now, where it cracks, where margin cracks, where leverage cracks, where money flow catches something that's falling, I don't know. So I do submit to you that we are going to see something catastrophic. And I think that might be too strong of a word. I think the market comes down a couple of thousand points over the course of the next month, 2 months. I believe once that low is hit, which I still believe will be higher than the low we reached before earlier this year, I think it was January 28th, or maybe it was somewhere in March, I don't know. But I do think the lows of this year are already in. So do I think we retest the lows of the year? Yes. So anyone that believes that you're just going to buy a market and it's going to continue to go up, you're missing everything. So that's where we are. We believe the market goes lower before it goes higher. Bonds keep going down for a while, then is the likelihood? I believe so, because the thing with the bonds is saturated, is that the word? It's the market that has the most players in it. And when you bought the bond market, and not you personally, but when another country bought the bond market, they said, hey, US, you owe like $30 trillion. You're in deficits every year. Why would we buy your bonds? And the US said to them, don't worry. We're net buyers of our bonds. We're going to buy 120 billion worth of our bonds every month. So don't worry, just buy it. And we're going to continue buying it. Therefore, there'll always be a support for the price. In fact, you can buy it and then conceivably sell it to us. We're always going to be in the market buying it. That was the quantitative easing of the COVID, where we went ahead and continued supporting. Now the policy has changed. Now we're raising rates, which means we're telling everyone every bond is going to go down in value, because as we raise rates, new bonds come out with higher yields. Therefore, the existing bonds go down in value because they're not going to yield as much as the new bonds. So they've already told everyone bond prices are going to go down. But on top of that, they're no longer buying the bonds. They're scaling the bond buying back. On top of that, they're actually going to be selling bonds. So anyone that's ever owned the bonds because the rates were never going to go up, and the market was the Fed was going to continue buying it. Now they reversed the whole thing. Now rates are going up and they're selling bonds, which means all the reasons you wouldn't have bought a bond before, except that the US said, hey, listen, don't worry about it, are still the reasons you wouldn't buy it, plus additional reasons why you wouldn't buy it. So anyone in the bond market is going to be a seller. And eventually it's going to hit a point where someone's like, I can't keep losing all this money. Just sell my bonds. Like I'll just keep selling. So in our belief, we believe bond yields will continue to go up. I don't know if I see a reason for them to stop going up. And full disclosure, we've been talking about this day, and that's not directed at you, but anyone watching, which are a lot of people. Full disclosure, we've always said there's going to be a point where the bonds just start going up and they don't stop. Because it's a self-fulfilling prophecy. The higher the bond yield goes, the more reasons there are to not own bonds. Because a bond is a promissory note to pay the interest rates. So if the interest rate goes up, the borrower is now on the hook for more money. So people sell it. And by them selling it, the interest rate goes higher because bond prices, when they go down, the interest rate goes up. Hey, nobody wants to own this bond. Okay, I'll give you a bond at a higher yield. Meaning the more people that eventually sell it. So this is the way it works. Bond price is bond yield. Right? I think we're here. No, we're here. We'll eventually get here. So there might be a little bumps on the road, but we believe bond yields will never be as low as they were. Probably for the history of the United States going forward, because we think the United States, this experiment is already over. I don't know what the US will look like 20 years from now, but I am comfortable saying I believe that you will never ever for generations to come ever see a bond yield as low as it was. So that's our commentary. Let's go take a look at some stocks. All right. All right. Let's move this over here. Well, first let's look at the market, right? Okay. So let's take a look at the indexes, and we can very clearly see, like we've always said, the Dow is where you see the large money flow. And it's because it's the 30 largest trophy assets of this country. Apple, Caterpillar, think, what are the Disney, Home Depot, UPS, or is it FedEx? One of them, right? It's down 0.48%. The S&P is the index is down 1.1%. The NASDAQ is not only interest rate sensitive, but it's where all the stockbrokers go, so retail people. Because I can make a sexier story to go by NEO than I can to go by Home Depot, right? So if you're selling stock to someone over the telephone, this is where you go. And these are the exciting companies. All right, this is going to change the world. This is going to change the world. Down 1.75%. So very clearly, you can see the money flows going to Dow. I know it's down, but it's down, what, like 30% of what this is down? And then the Russell's only down 0.08% because we've always said, well, the Russell is all domestic, right? So they're a perfect hedge against currency because if the currency gets inflated, they only deal in the currency, so the stock goes up. But also they're small enough that large companies that have a ton of cash in the balance sheet will go ahead and buy these companies because they're small. Now the VIX is up 11.39%, which is the volatility. So that's all that. And I swear to whatever, that for the life of me, I will never get a stock that just falls apart because we have a stock market getting killed, yet this is down $1. But what we can very clearly see, broke trend, making another low. This was a 20. We bought it at a 20. It turned into a 19 because it closed the lows of the day. We said with Eli Lilly, one of the errors we believe we made was that was a warning, a red flag, which conceivably two things. One, I'm not heeding it because I don't think it might have been the red flag I thought it was, which also is part emotional. But I see it broke trend. I see the line crossing down. It's now at the solid line. It already broke this top line. When it breaks this line, see you later. And I feel very comfortable with this, right? It's down on a down day, blah, blah, blah. So let's take a look at the tech market. QQQs is the tech. So I want to go ahead and pull this back. Okay. And what you'll see is, this is COVID, right? Okay, so it broke that trend. So let's get that out of here. Okay. So what do we see here? Let's get rid of this. Let's clean this up a little bit, right? Okay. Where's this line from, first of all? Let's find out. Okay, this top broke it. Once it broke it, never came back. Found support there, broke it lower. But the point is, you can see that when it's over it, it goes much higher. And when it's under it, it goes much lower. And when it stops on it, it changes direction. So that's called a support line or a resistance line, but it's very important. So let's take a look at tech recently. What you'll see is it broke support, right? Boom, boom, boom. Where does it stop? That's the question. Conceivably, this line is going to be the test. Now, put yourself in the role of a money manager. When you see this, you say to yourself, what? You don't think of, well, the macroeconomics of it is that the interest rates might go to this, and then if China buys this many bonds, and if Russia sells this many bonds, the interest rates will normalize over here, and that normalized interest rate. No, that's not what you do. You think, okay, this is close enough to this, so I am selling, and then I'll start buying when it gets here because I can see this line. That's what the majority do. And because the majority, by definition, is more buyers than sellers or more sellers than buyers, that becomes a magnet. So we can see that this line right here is 334. We can see that we're at 342. So we can say with quite a bit of confidence that the next 8 points on the NASDAQ will be lower. Now it's down, what, 2% today, less than 7 points, which means we could say the next 2.5% of the NASDAQ is lower. And if that's the case, then you want to be short the NASDAQ, or you want to be taking a look at names that you think have been overdone, because if the market stops here and goes back up, they're the ones that are going to do the best. But what if it breaks this line? Then what happens? Well, you're retesting these lows, which is 318, which is 22, 24 points from here. So that's about 8% lower. So if I told you that the NASDAQ is another 8% down, you would say, whoa, that's quite scary. That's a problem. Well, are you prepared for that? Is your portfolio prepared for that? Now, there's two ways to prepare for that. Either A, take short positions and make money as it goes down, or B, make a list of stocks you want to own, put in price points. Oh, if Apple got to 150, I would buy it, and then be disciplined. On that paper, Apple 150, I would buy it. Therefore, when it gets to 150, don't listen to the headlines. Remember, Apple could only get to 150 if the headlines are terrible, because that means everyone sold it, which means, oh my God, Tim Cook, he lost his mind. He doesn't have, sorry, my grandmother's calling me. Sent her to voicemail. Okay. Oh my God, Tim Cook lost his mind. He got kicked out of China. Apple will never recover. This is the death blow. And you might say to yourself, well, Aunt, I said I was going to buy it at 150, but do you see what's going on? This is going to ruin the company. That's the point. It will never get to 150 unless you see those headlines. So be disciplined. So there's two ways of doing it. Either ride the stock market down or come up with a list to yourself and say, if these stocks hit these levels, I would buy them at those prices. That's the only two ways to do it, but you have to do it with a clear mind as you have right now, okay? So that is our commentary on the NASDAQ. Now let's take a look at our super duper list. You know what's pretty cool about this? Well, not pretty cool, because these are all the stocks we would say go lower, and they're all up. And these are stocks we would say go higher, and most of them are lower. So let's take a look at our super duper list, right? And then we'll get going. So Twitter, we like a lot. Oh, that was the other thing I meant to say. Oh, I'm back. So when you take a look at our ledger, you'll see that we owned Twitter and we made over 100% on it last week. You will then simultaneously say, well, we never saw that trade update. And Anthony never said anything of it. Two things can be right at the same time. Twitter, and in full disclosure, when we met Monday, I spent time talking about Twitter because I am also cognizant that things that I do, whether I like to admit it or not, to some people are a recommendation, which they're not. That is illegal. I will never get arrested because anyone convinced that I was making a suggestion on securities, because I don't have a securities license to do it. But do I believe that if somebody was sitting next to me at a bar and I told them that I was buying Twitter, they might say, hey, you make sense, I'm going to do it too. Which means I'm kind of sort of in a way, if they then lose money, they say, oh, I wish I didn't listen to you. In which case I say, I never told you to do anything. And they go, I know, but you were just so sure that I did it too. I wish I didn't listen to you. That being said, there will be sometimes that I make a move by myself because I understand that there's a higher level of risk associated with it. And I don't even want to share it with anyone because I'm capable of taking that loss if I need to. What I'm incapable of is being the reason, whether warranted or not, that someone else loses money on a gamble. Now, when I purchased Twitter, I bought options that expire this week. And I did it last week when Twitter was up 25% already. Because what I believed was the Elon Musk name is going to be enough to have the Reddit crowd, to have the retail sites, the speculation, the boards get super excited. So I bought Twitter $49 calls that expire this Friday when Twitter was $48 that Monday. Twitter went up to $54 the next morning, which meant I was up over 100, 150% in 24 hours. But I purchased calls on a stock that expired in less than 2 weeks that was already up 25%. That's crazy. That's really like you're going for it. You must know something that others don't. And I believe that what I knew was that the emotion of the market would trust Elon Musk beyond all reason. And I wanted to profit from that, especially since I just sold Eli Lilly at a 65% loss. So some will say, Ant, you took a 65% loss and then you made up 100%. Like, how can you do that? Because our process is the same. We go ahead and find the opportunity as it comes. We never really do anything that's much of a cowboy. Even I'll say, well, I would never tell anyone that I did that, but did I feel comfortable doing it? I did. And in retrospect, I thought to myself, do I wish I made that public? I still don't, because that could have gone the other way very easily. Imagine losing 65% and then losing 60, 70% the next day because a stock that was up 25% gave back 5%, and I'm in options that expire in 2 weeks that already have it embedded in them that it's going to go higher. I could have been down 60% in less than an hour. So that's my commentary on that. All right, so let's take a look at the super duper list. So Twitter, we can see hit a 17, crossed over, but it's going down on lesser volume, which is higher than this volume. Now, the news of the week, I know I have a low battery phone. I don't need you to tell me that every 2 seconds. So my phone is telling me that I have less than 10%. So it's good that we're finishing soon. The news of the weekend was Elon Musk rejected the offer. He was on the board. Well, he was going to accept the offer. He no longer accepted it because, in my opinion, the terms of the board, which this is all fact, is that by agreeing to join the board, he's not allowed to purchase more than 14.9% stock. Okay. All weekend, he was posting different polls of how he can make the company better. I think, in my personal opinion, that Elon Musk is too much of a brand name like Donald Trump was, that they do things that might not always be logical to the layman, but they're comfortable losing money on something because it goes ahead and supports their brand, right? So Elon Musk, he tweets about Twitter and then he goes ahead and buys Twitter. And people are like, I can't believe you bought that thing. It's the biggest POS. It's going to lose you money. But the next time that he goes ahead and tweets about something, they're going to say, whoa, he bought the last thing he tweeted about. So we got to be careful with this guy. The point is, these guys that are the richest men in the world, they're not there by accident. And people might say, look how dumb they are. They lost money there. No, because they're playing chess. They don't mind sacrificing the rook here because they're going to checkmate you over here. So I believe out of pure pride that he's going to buy Twitter. So when I see it going down, I'm very motivated to buy it, which actually I want to say one more thing about that. I don't often pat myself on the back, but anyone that's been part of this platform has known that I have said one single thing about Twitter. I've said it the whole time. I am completely mystified while no one buys this, that it takes someone that has a vision to see that this is the news industry, that if you bought Twitter, it would be the best purchase anyone ever had, that they have the money on the balance sheet, that they have the use, they have everything if somebody was a visionary enough to go ahead and do it. Do I find a bit solace in that the person that eventually finally did it's Elon Musk, the richest man in the world, the man who's the most popular man in the world, that's credited as being the biggest visionary that's invented more stuff than ever, that the only other person in the world that agrees with me, his name is Elon Musk. Yeah, I think that makes me feel better about me, because those that know me know we're building RHINO, right? Like we're building something that's going to change the world. So if the other person that's changed the world more than anyone is the only person that agrees with me while I'm doing something different, two things are true. One, I already believe that I was on the right path, but I believe it even more now. But secondly, I believe what we're doing at RHINO is not exclusively our idea anymore, because I don't think he's going to be able to do what we're doing, because not that he's not smart enough or doesn't have the resources, he doesn't have the free time. Every second of every day of me is devoted to this. So unless he can do that, I don't think he can do what we're doing. And because all of that time is spent at Tesla and Boring and SpaceX and all the other companies, by definition, he can't do what we're doing unless he's 5 times smarter than we are and he doesn't sleep. I don't know if I would say he's 5 times smarter, maybe 3 times, but I also think he does sleep. So, but we need to move our butts. So things are happening. And I think that was both things. Okay. So I know I have less than 10% on that battery. So let's go. All right. So our super duper list. He almost doesn't sleep. Yeah, I know. Well, you can ask my wife. I almost don't sleep too. JB Hutt is a 15, red and green. We wait till 20s, but it's a 15, so it's on our list. Morgan Stanley reports earnings Thursday. It's a 14, red, no green. If this becomes like a 17, 18, 19, whatever the math, a 17, red and green before earnings, we might take a look at it as like a buy it and sell it to the suckers type of thing. NVR, 14 red, no green. KBH, 14 red and green. Hovnanian, 14 red and green. ICE, which is Intercontinental Exchange, they trade commodities, 13 red, no green. 12 little green, no red. Barclays, 11 red, no green. This isn't even a symbol anymore. See you later. 11. Okay, so these are the buy list headed by JB Hutt. None of them are where we buy it, but there they are. Okay, this is down $1.26 now. It just looks perfect. It honestly looks perfect. I wish this said 20, but that's the only thing. And even when it went down, volume stayed high. So let's take a look at this list. So this looks like it's crossing over the top finally. This did cross over the top. Pharmaceuticals finally down 64 cents. Wow, but it's still, we need to see a crossover here. But these are really, really running quite strong. $21. So these are our, they've gone really, really far, but we need to see confirms. Like we need to see this cracking, right? But just to show you, we are on it. Now, after the market closes today, we will go ahead and do an inventory of a new list. We'll go through every one of our stocks and find it, and we'll add it tomorrow, and then we'll have the emails all week. But full disclosure, this is what we're short, and we're all in. Now, let's do some housekeeping. Let's take a look at crypto, and then we're going to look at Don's list, and then we're going to get going. Crypto's important because 40,000, where I have this line right here, is the line, right? So let's draw that line. Okay. So this is basically the line, right? So it's kind of like there. Okay. It's 40,015. If it cracks under this line, that whole NASDAQ thing we talked about is going to cascade lower. So if you see crypto under 40,000, like run. So I wouldn't be well, here's the thing. If you want to buy crypto, you can, but if it gets under 40,000, you have to be disciplined and sell. So you could buy it, and if it holds this, if it loses no more than 800, then you're good. Continue buying. But if it breaks under 40,000, get out and run. So let's take a look at the list. By the way, did we not nail Solano? Like we talked about it here, 145. It's 102. And if you don't believe us, go through the emails, right? So what is Bitcoin? It's a 7, red and green. So it's getting to the buy zone. It's not there, but if you are looking for an opportunity to get into Bitcoin finally before it makes that next run that's going to change the world, that might be coming to you in the next week or two. So don't get too excited like today. Don't blow your money. But if that opportunity comes, I promise you, I commit to you that we will be doing it too, and we could do it simultaneously, not together, because together is illegal. But I don't see anything of noteworthy, right? There's no numbers anywhere. Okay. So nothing in crypto, except we're looking for an area to get in. Daily, UNG 21 didn't cross over yet, but it looks like it, might be time soon, but not yet. But UNG looks like it could be a big sell at some point, if it ever becomes that, and we will be there to see it. Oh no, I'm happy to do it. And it's not like I started doing it for your benefit, but also your list is all commodities and bonds. These are things that I don't run through, and they're things that we need to run through, or at least I need to know. So, so thank you. I want to run through it. We have 11 on oil. So let's move that over to super duper list. Oil might be setting up for a buy soon. I don't see a confirmation in green, but if I get that, so let's take a look at oil. Maybe it's something to start thinking about getting long. And that's that. Yeah. Also, I actually bought some silver for Christian, physical silver, and we put it away for him. All right, so I believe my phone's probably at 3-4%. So if I don't say buy now, the phone will say buy for me. I do apologize for being late today, but if I can submit to you that it was for our son, I would like a pass, because I wasn't late because I slept in or something. And everyone gets the email tomorrow. I thank you. I love you. And I will see everyone. Bye, guys.